Financial Survival Network, helping you survive and thrive in the new economy. Go to CarrieLutz.com and sign up for 30 free micro trainings on financial survival.
1490 WGCH. This is Kerry Lutz, and you're listening to the Financial Survival Network, which is brought to you by Miles Franklin. They've been in business selling gold and silver for over 20 years, and I'm a customer because when you buy, they ship. For more information, find them on the web at milesfranklin.com or give them a call at 800-822-8080 and get a free quote. Hi, it's Kerry Lutz here. We've got a new feature on the Financial Survival Network, and that's the Value Guys Stock Talk Show. The Value Guys are certainly what would fall into mainstream investors. They like stocks. They like undervalued stocks, stocks that the market has overlooked for whatever reason. We're really fortunate to have them on the Financial Survival Network. They're going to be a regular feature. They're on the radio show. We're posting YouTubes for them. And don't forget, Financial Survival Net. We have a YouTube channel. You can check out a lot of our interviews. You can check out all of our interviews. A lot of helpful advice, information there. On that note, please welcome Mr. Val Hughes and Mr. Momentum. They are the Value Guys.
Hello, everybody. Welcome to another edition of the Value Guys Stock Talk Show with the Value Guys. I'm Val Hughes.
And I'm Momentum.
And we are 31.3-year Wall Street veterans that have taken on secret identities and gone underground in order to provide you with our candid views on a handful of stocks we screen for here in the shop each week. You've seen our faces on TV. You've seen us quoted in the news, but our bosses would never allow our unfiltered views on the air, so we've disguised our voices, and they'll never know. This week is the May 4th, 2012 edition of the Value Guys Stock Talk Show. And this week, Mo, you'll be interested to know, we've got a new type of screen going on this week.
Really?
Yeah. We've been doing a bunch of value screens, like we did our PE screen, our enterprise value to sales screen, our price to book screen, all the kind of stuff we actually do here in the shop to find undervalued stocks.
All right.
And this week, I thought we were going to have to go do the PE screen again, but I have a new screen I worked on. But first, a couple of important caveats. First, this show is for entertainment purposes only. That's not a guarantee. Secondly, Mo and I are professional analysts during the week, and we do a lot of careful work on the fundamentals. We do earnings projections. We talk to management. We review conference call notes. And, of course, we've done absolutely none of that here. I've tried to do as little as possible, as usual.
I thought you were cheating earlier. But
yeah. No, I did a few things. Third, and our lawyers say we need to remind you that we may not have your best interests in mind, so do your own work. We may accidentally recommend that you do the opposite of what is really best for you.
We may intentionally do it.
Yeah, and that's our choice, isn't it? But not really. Okay, and then fourth, and this may become increasingly obvious this week, we have been drinking. It's just after work on Friday, we're kicking back. So,
Grey Goose.
Yeah, so we've got a nice new bottle of vodka this week, thanks to you, Mo. Looking pretty good.
Yeah.
I know it's helped my stock picking,
Well, helped,
So anyway.
no comment on that.
So I've got some important, I don't know if it's important, but interesting, exciting news about the Value Guys. The Value Guys are now available on YouTube.
Yeah.
Amazingly.
Yep.
We had nothing to do with it, really, but thanks to Kerry Lutz and the Financial Survival Network, they have put our show on YouTube, and evidently they'll be having it on the radio on a station in Greenwich, Connecticut, 1490 AM WGCH.
I was on it this afternoon to just look at it, and there are nearly 5 million hits on that YouTube.
Really?
Yeah, our very first YouTube debut.
Yeah.
It's been amazing. It's what they're saying. It might be one of the biggest things that has ever happened to YouTube.
Yeah, but no English speaking hits. That was the odd part, I thought.
Yeah.
A lot of foreigners, and who knows? I guess the music was terrific.
Well, I went on. I looked at it. I was impressed. I was I was looking around when I was in there because, when we come up,
Yeah.
on the right-hand side, there's all of the other shows that if you like us, you might like them.
Right.
Some interesting stuff out there.
Well, cartoons, they're getting confused about our logo now.
Right under the Value Guys on YouTube, at least as of this afternoon, was the RV Learning Network. Now listen to this.
The RV Learning Network.
Some big stuff here.
Huh, okay.
RV stands for remote viewing. So they've just declassified a trove of top secret CIA research.
Really?
That was called remote viewing. It's what the CIA and the Army used before drones. It's how they got to see behind enemy lines using psychic.
Why are you doing research into this? What are you guys working on over there?
Listen to this. Listen, Ed Dames is a retired military officer.
How do you know Ed?
He's
this is
on
all
the
mysterious, Mo.
He's on the YouTube video right underneath the
so
Value
you learned
Guys.
this.
So you learn this by watching that YouTube video.
All right.
And according to Ed, who's been involved with the CIA, this is the most groundbreaking, scientifically developed, teachable mind skill in the world, and he has a financial markets application.
Really?
So you can harness your psychic powers. You buy the DVD. It's listed right under us. It's called Remote Viewing.
Really?
Yes,
Wow.
by Ed Dames. And you buy the DVD.
Is he paying you or something?
No, but I'm buying the DVD,
What?
and you're going to do one screen your way,
I
and
am?
I'm going to use my psychic powers, and we're going to see whose screen does better.
He's got a psychic screen versus our fundamental screen. Is that what you're saying, Mo?
Yes.
And you think it might be an alpha generator?
I'm
I
telling
mean,
you.
it's worth a shot, I guess.
So next week.
Yeah, bring that in. That's crazy.
Yeah.
Well, I mean, there's already advantages to being on YouTube, it sounds like. All right, well, this week we do have a screen, and for the last couple months, we've basically each week been doing a different screen that Value Guys do in the shop. And how do I know that? Because we're Value Guys, and we're in a shop, and we do these screens to find stocks. So it's primary research, and it's not meant to be a black box to figure out exactly which stock to buy by any means. It's meant to be, in effect, a filter to give you an inbox, right, of things to work on. So this week, we did something so realistic because today in the shop, we had a research pizza party, and the goal was to have all the analysts bring in a handful of micro-cap ideas. And this is stocks under 500 million. You know how many analysts these stocks have covering them generally? I'll round up. 0. So it's completely untouched territory, basically. And so, again, to save time and do as little as possible, I'm just piggybacking on the hard work of the analysts here. And, frankly, they don't like it, but, I'm not telling them. And they're not listeners. So
The other thing that's interesting is they're legitimately good ideas that were brought to a public forum. In the old days, we were stuck using that whatever was in that week's value line.
Yeah.
This lets us graze more
well, we're just,
effectively.
this is a realistic approach to
I think it's better.
building a portfolio. That's what we do.
Okay.
And I'll tell you, we don't own any of these.
Yet.
But, this is the stuff we actually looked at in the shop today, and we picked out a handful of them. So there's four names we want to talk about today. First up is Corvell Corp, ticker CRVL. Second, and we are going alphabetically. We're sticking to that tried and true method. Yeah. EasyLink, then that's ticker ESIC. Interparfums. I don't want to mispronounce that, but I already have. IPAR, and that's been around for a while, and that does actually have more than 0 analysts. It has 7. And then a company called, again, I haven't heard of this one, Intersections, ticker INTX. So we're going to get into that. And then we're also, at the back half of the show, we're going to have Walking Through National Economic Trends, that exciting segment where we page through this and see if there's anything interesting. And there's always a couple things, so we'll have that. And then we're introducing a new segment today, and the reason for that is it was sitting on my screen and Mo thought it was interesting. So we're going to call that this chart on my screen. And this week, it's a ranking of all the performance of the various industry groups.
Yeah, it's
so whatever. It's the end of the quarter. We were kind of
interesting.
Or end of the month. We were kind of looking at that. Okay.
First up.
Oh, and you know what? And excuse us, regular listeners, this is for, evidently the show's on the radio. So I need to say this. You're listening to Stock Talk with the Value Guys. Up next is Name of segment. What's that?
No, that's, I think.
Up next is Corvell Corp. The Value Guys are back talking about, we're doing Corvell Corp. Listen in every Tuesday on the Financial Survival Network on 1490
WGCH.
Okay, so that was fun. All right, first up, Corvell Corp. This came off a screen that was a microcap screen, so stocks under 500 million. And I also just screened for stocks under 500 million that had a good return on assets. So as we've talked about in past weeks, you don't always have to screen on low PE and stuff because you might miss some good companies that might be a little more expensive and you're willing to pay up, that kind of thing. So we've got pretty good margins this week. This Corvell, it's got what I was attracted to was just mid-teens margins, growing sales, a good return on assets, and then I look at the business description. That's interesting. What do they do? Well, Corvell, I'm just reading out of the 10K, is an independent nationwide provider of medical cost containment and managed care services designed to address the escalating medical costs of workers' compensation and auto policies. So what these guys do is they go to firms that are already insuring your health. So workers' compensation companies are insuring, your good health in the workspace. And then auto policies are covering the medical for people in auto accidents. Those are their customers, and they're helping them to reduce the medical costs. So they're doing all kinds of things: claims management, bill review. They're working with the networks to optimize that, utilization management, which is just like capacity utilization. So they're adding a professional layer of management, in effect, as an agent for the broader insurance company, and they're getting paid pretty well to do it. This thing looks like a utility. The margins are so stable. And then the returns on capital are mid to upper teens. And whether we retain Obamacare or we don't, I don't think there's going to be any let up on an approach toward cost containment. And then, the valuation, 7 times EBITDA. And listeners know I like to flip that over. Think of it as an earnings yield, 1/7. It's about 14%. So if we bought the whole company, we bought all the stock, we bought all the debt so we could have the rights to the cash flow that's now going to interest, and we, subtracted out the cash, we would earn a 14% cash on that investment. And the market cap here is $450 million. So, the guys in the New York Athletic Club right now could get together and just buy this, and they'd have a 14% return, and that might be better than they're getting. And look at this, analyst coverage. Zero. So I'm interested in this, Mo, and we threw it out on the table today, and the team's going to go do some work because we don't know anything about it other than what I've just said, but it certainly looks interesting, don't you think?
It does, and I would have thought that a company like this would have, much higher sales growth because, come on, medical cost containment, that's probably the biggest growth industry in America, maybe outside of energy, but they had a 9% growth in 2010 and a 12% sales growth in 2011. So I'm just wondering, is that the business? I would have thought it would have been a lot higher. But on a more serious note, here's a question, and this is purely technical. In 2009, the stock was up 50%. In 2010, it was up 44%. In 11, it was only up 7%, and so far 2012 is down 20%. So I worry, we sort of peaked here with the enthusiasm for cost containment. Are people throwing in the hat and waiting for a better outlook on what's happening with Obamacare? But
that's what I think it is right there.
You think right there?
Yeah.
Because it looks like the stock's sort of turning over. And I don't know that I want to jump on when I'm seeing that kind of loss of longer-term momentum. But maybe that's what they're waiting for.
I think, you have to have some conviction that these services are going to still be in demand. And I guess the bear case might be that the government is going to take over stuff. They're putting taxes on, medical products and such. Maybe people feel that somehow this is going to be taxed in the sense that it'll hit demand, but it's an add-on product to existing insurance policies.
Yeah, but
So I think that if the market is being cautious on this, they're not digging in. It's babies out with the bathwater, because this is professional management on a very specific piece of the healthcare pie, and that is the part that comes into play when you're in an auto accident or when you're hurt at work. And so they're very narrow little niches within. And my guess is that they have corporate customers who are ROI based. And the stability of this margin tells me that the ROI is, whether healthcare costs go up or down, it's like hiring lawyers to attack patents rather than have scientists invent drugs. The ROI is good for these insurance companies to hire this specialty manager, and that's what I'm excited about. That it appears to be some type of annuity, and it's not too expensive. So, and zero analysts.
You got to love that.
Honestly. So, anyway.
Technically, we're the first 10. We're kind of analysts, and we kind of did an analysis.
I don't know. All right. Okay. Next up, EasyLink Services International, Class A. Now, I'm not a fan of that, but we'll just ignore that for now. I don't know. You want to like this one?
Cloud-based applications. So they must... it's an agricultural firm that seeds clouds for rain over crops.
We don't know that much about this. Could be.
I mean, cloud applications. What other cloud applications are there?
I have no idea.
Cloud. There's cloud
Secure
mitigation
networks.
at airports. If it gets
well,
cloudy.
Let's,
so they're cloud-based.
Let me grab that bottle back from you. No, they. What do they do? They're integrating networks on big platforms, so companies can communicate.
Wait a minute, I thought these were on clouds, not platforms. There's a big difference there.
If you have a lot of people flying around, I suppose. But, it's the internet. Mo, you know about that.
What that surprised me is they let two companies talk to each other on secure networks. I never really thought as a person you don't think about that. You'll just email stuff. But if you're a company, you want to hire these guys to make sure you've got secure communications between either you, your customers, other people in your network. Right?
Yeah,
that's what they do.
Well, sales information, terms of contracts.
You don't want somebody to be able to hack that. And yeah, I understand.
So I guess so. I mean, they're earning whatever it is they do, and Mo and I we're pretty much expert on this. Wouldn't you say, Mo? But not enough to really know what we're talking about. I would also add, but the margins here are remarkably stable. So I like that as an analyst.
And the gross margins are
70%. What's not to like? Stock at 6 times EBITDA. So when I see great margins and a cheap multiple, of course I'm worried something's wrong, and that's where you have to go do your work. Mm-hmm. What's about to go wrong is always the question that you should be asking. And I'd say anytime you find a stock at this level, only 1 out of 5 or 1 out of 10 actually ends up getting bought. Just to throw that caveat out, this isn't ready to eat yet. It's got to cook a little bit here.
Speaking of the number one.
Which number one?
You just said number one.
I did?
You did? Speaking of it, there's only one analyst.
Oh, one analyst. Yeah. That's a positive. Return on assets, pretty good in the mid to upper teens, at least the last couple of years. They had a bad year in 2009, but it looks like a write-off versus anything else. And
they also bought. Look at 2011. They bought something. Assets went up $100 million. Long-term debt went up, $70 million.
Yeah.
Shares went from 29 million to 32 million. So they clearly bought something. You see the big jump in the stock price. So that's
and the cash is down 20 million.
The market this year loves the acquisition, apparently, because the stock's up 50%, 2012. So that would suggest, whoever they bought, they seem to be doing a relatively good job of integrating it. The market loves it. It's been a monster stock. The question is, are we getting on too late?
Well, from a technical point of view, which I don't ever really take, I mean, it's off. There were so many stocks in 2009 you could have bought for $1. And now they're at 10. This one you could have bought for $1.50, and it's 6. So $4
left to go according to that analysis.
It's up, but over that same period, let me see here. Cash has tripled. Sales have doubled, much of which is due to an acquisition. But, the company's making some progress. Let's see here. I guess their debt is actually at the high right now, so I can't say anything
because
good
they just
about
did
that.
this
They did the
acquisition.
deal.
Yeah.
So, I don't know. The thing I'm mostly attracted to here is these margins. When I see a 70% gross margin, I mean, just think about it. That means that I'm getting 70 cents for every dollar of sales, which means that whatever it is I'm doing cost 30 cents, and I'm charging $1. That means I've tripled the cost. Now that's of goods, but if I do that same analysis on the on the EBIT margin, let's just round it. I got a 25% EBITDA margin. That means that for every dollar of sales, I'm getting 25 cents in profit. My costs are 75 cents, and I'm charging $1. That's a 33% markup on cost. Why are customers willing to go for that? Well, because they can't do it themselves, and so there must be something. I mean, when you see 5% margins and things like that, that's just, hey, buddy, why don't you do it? I'm busy. But when you see 25% margins, it's like, crap, I wish we could do that, but we can't, so we got to hire this guy.
Now, you know what? Here's just a mechanical story or issue. We know they bought something, and that's why the stock's been so enthusiastic. Because when they bought something, their sales went from 81 million to 164 million.
Yeah, clearly they did something.
So the question is, are they integrating this thing? Well, when you look at the first full year that they owned it, margins dipped a little bit from 72% to 65%, but that would suggest that the integration process is going well. We know there's only one analyst who follows it. So usually what happens with a stock like this is they bid it up 50% just because they know they bought something, sales are going to double, I'm on this stock, I have a trigger. If this story is a great story, it's probably not baked into the stock yet because there's only one analyst who would know we're only a quarter of the way through what this acquisition is going to do to the company. So this may just be a knee-jerk reaction on the part of the market. If it's a really powerful story, we may have miles to go before the story plays out.
I think so. I mean, look at this target price for the analyst.
How do we find this guy?
I don't know.
We
the analyst?
Yeah, that's you want to call that guy.
I don't know who he is. But his name isn't here. But anyway, so that's worth a look. EasyLink Services, ticker ESIC. Kerry wants us to say this again. I guess he's running commercials. Why don't you take a turn?
You're listening to the Stock Talk with the Value Guys. Next up is name of segment.
No, wait. Wait a minute. Here we go. Okay, let's do that. You want to do it over?
You're listening to Stock Talk. Stock Talk sounds like we're farmers.
Stock Talk.
Say that 3 times fast.
No, I don't. Look, it's. Let's try it. That's Kerry. Don't use that one. Okay.
You're listening to Stock Talk with the Value Guys. Next up is name of segment.
No. Come on, man. All right. You want me to give it a try?
Next up is parfums.
Interparfums. Maybe we should just give the ticker at that point.
Sounds like something that happens when you eat too much Mexican food.
You're listening to Stock Talk with the Value Guys. Up next is Interparfums, ticker IPAR. Wow. How about that?
Interparfum?
I don't want to get into that. All right. Okay. The Value Guys are back talking about Interparfums. Okay. You're going to have to edit that out, I'm sure, Kerry. All right. Interparfums. Let's see.
Now, this is opposed to the outer parfums, and I think that's an entirely different...
We're going to do that next week.
That's a different business.
Yeah. Okay, this guy, again, we ran the screen, microcaps, so it's 470 million, which is tiny, although there's 7 analysts, and we've talked about this before. That either means there's an industry, and this guy's in it, and they all have to cover that, and they might as well do this one, and I think that's the case, because Estee Lauder's 25 billion, Elizabeth Arden is $1 billion, these guys are 400 million. So, they're just laying out there, if you're an analyst covering some of these branded companies, you end up having to do it. Or there's a bunch of bankers running around trying to get this thing sold, and they're getting their analysts to cover it so that they can, peddle the company. Who knows? But it's a 60% gross margin business. That's attractive. It's 6 times EBITDA. They grew pretty well all through the recession, like that. And so I look at what they do. They, obviously the name tells a lot, but they develop, manufacture, distribute perfume and cosmetics. And I think their biggest relationship is Burberry, where they do the perfume. Also Van Cleef and Arpels. I'm sure I've bastardized
It's Arpels.
Arpels. Jimmy Choo, Paul Smith, Mont Blanc, S.I. DuPont, and a couple of other things. They own Lanvin perfumes. They own Nickel, a skincare company. So they own a bunch of things. And they do perfumes for, like, the Gap. They do perfume and other fragrances for Brooks Brothers. Yeah. Nine West, Lane Bryant. So, I don't see all the breakout here, but undoubtedly, if you look at their sales of $600 million, some portion of it, maybe it's $200 million or something, they design their own perfumes and own those brands. But it looks like the larger component is them licensing the brand name and then
stuff in a bottle.
Putting the stuff in the bottle. And they may own the fragrance, or they may not. Who knows? I don't know. But they're putting up these high margins, and then they got a big royalty payment that comes out in SG&A, which is about higher than usual, 40-50%. And then they're putting up mid-teens EBITDA margins very consistently, Mo. So you look, it's almost like the owners of the brand are saying, hey, look, IPIR, you can earn a little money, but it's got to be between 11 and 14% or we're going to come after you. Because it's right in that zone, and I bet it's exactly something like that. Return on assets is low, which you'd say, well, why would that be? And, of course, I don't know. I'm doing as little work as possible. But I think it's possible that when they write these contracts with the brands, that they take those payments over the life and they roll it up into like a lease payment type of thing, and then they have that in their assets or in their capital. And so it erodes their return on assets down to what would be a market return on assets. In other words, 5% on your investment. If you put money in T-bills, you've got a 2% return on assets. So on that sort of market value basis, that's not terrible. And they leverage it a little bit into a 10-11% return on equity, which, again, in this environment, if it truly is an annuity, that's a good deal. I do know people like their fragrances. We have a Spice Islands for a reason, and it's been going on ever since. And so 6 times EBITDA, that's a 16% cash-on-cash return. The balance sheet looks to be in decent shape. Long-term debt is 0, and total debt is single digits. So, I'm interested in that, Mo. What are your thoughts on this one?
Well, you can tell what a good business model.
It smells good. I just want to say.
Very bad.
Sorry about that.
So one of the things you can look at this company and you can say, easy on that stuff. They do $645 million in sales and they only have 283 employees. That tells you an awful lot.
$3 million per employee.
That's a lot of money.
Yeah.
If you go back and you look at Corval, they do half the sales with 2,900 employees. So you got to like their business plan. But here's what I'm wondering. One, just another mechanical thing. 7 analysts following this company. This company does 89,000 shares a day. How does 89,000 shares a day feed 7 analysts?
Let's do the math on that.
It's here. You can have mine. That's not pretty. Anyway, while you're doing that, it doesn't make sense that they would ever generate. So, the stock was a killer stock in 2009, 2010, up 58%.
That's $300,000 in commissions per year
for the whole stock.
Yeah.
Now, what's that
at
divided?
2 cents.
What's that divided by 7?
Bonus time. That's what it is. Oh, wait a minute. What did I say? Let's just say 350,000 divided by 7. That's 50,000. So
50,000 gross potential
but
revenue.
the sales guys are getting half of that.
All right. And then the
banker,
firm.
yeah,
and
the firm takes their. I mean, you're the analyst.
So, all right, Paul.
You're
Anyway,
not getting any of that.
here's what I'm thinking. There's 7 guys that were following this stock because in 2009 and 2010 it was hot. It was up 58% in 2009, 54% in 2010. Nothing happened with the shares, so it wasn't an offering that got all these analysts on board. I think they loved whatever the business plan was, but here's what worries me. Sales in 2011, 34%, so everybody's enthusiasm is validated, but sales are only up 5% this year.
Yeah.
Stock has gone down 17% in the last 12 months. Is something going wrong? That's the only thing I'm worried about.
Yeah. Well, that's what you're always worried about
I
when
know,
you're a
I know,
value guy.
I know.
Is something going wrong? I mean, these stocks are cheap for a reason. It's either misunderstanding by the market or it's the company's going to hell, and you got to figure out which one it is. That's it.
It's a good thing we're not playing with
save
live
the graduate
ammo.
school tuition. That's all you need to know right now.
It's true.
Okay, are we doing the next one?
Enter.
All right. This again came off this micro cap screen we ran in the shop this week. So this is 200 million in market cap. I mean, there's buildings where there's that much, in the elevator.
Right.
And you could just buy this thing. And if you did, it's trading at 5.5 times EBITDA. And if we think of EBITDA as a cash flow, 1 over 5.5 is 18% cash on cash return. That's pretty attractive. So again, it's interesting. They've got, like some of the other stocks we've been looking at today, enormous gross margins. 60s, 70. Who knows if this is even legal? But no, it is. I'm just kidding around. And then there's a big sales cost because their EBITDA margins are in the low teens, 12%, and then EBIT in the upper single digits. But what do these guys do? I'll just tell you, it's fascinating, Mo. Look at this. Some of the 10K. Intersections provides consumer and corporate identity risk management services. The company offers subscription-based consumer protection, insurance, and membership services.
These are like bodyguards for your internet password.
Yeah,
that's what they provide you with, right?
I'm imagining remember Spy versus Spy? Corporate brand protection, business intelligence.
There's an oxymoron.
Yeah, we need that. Including online channel monitoring, auction monitoring.
Hey, bail bonds. They do bail bonds. Look at this.
Do they?
Look.
They do it all. So, let's see. They're helping people with online theft, fraud, credit profiles, online brand protection, and bail bonds industry solutions.
We should call Jim because he's probably working with those guys right now. But they're reducing his sentence.
I know. I didn't.
2 years.
Is that?
Shout out to Jim. Be strong, man. It's gonna go by.
I don't know. I don't know all your friends, Mo. I have to say, so I'm not. I don't know Jim.
Goldman Sachs will never be the same. Just so you know, we miss you.
How's his family? That's personal. Okay.
Do you know what's interesting about intersections?
But what do you think is?
Look at what they just did with the dividend.
Okay.
That would be down.
Let's see.
Look at what they just did.
What did they do? They
took it from...
Wow.
Yeah.
They really cranked it up.
30. First of all, in 2009 it was 0. And these guys have been around for a while, and they were trading pretty flat up in 2009, and there was no dividend, and all of a sudden a 30-cent dividend and a 70-cent dividend. Now, if that wasn't a one-time payout, and it's really 70 cents now.
Yeah.
Whoa, that's management is sending you a very powerful signal, but what you can't see is whether that was a one-time payout, which is why the stock popped, or is that now the new dividend? But that's interesting when you look at that. I also think the stock was up 113% in 2010. I think people knew that payout was going to happen. The stock got a little ahead of itself. And in 2011, it was up 6. In 2012, it's up 10. So it's kind of was growing into that valuation, absorbing that big jump.
Yeah.
So now the big question in my mind is the 70 cents, are we going to see that next year? In which case, you got a 6.6% dividend yield. If that's real, go for it.
Yeah, that's what they're posting. Yeah.
So, but that is it.
And it's covered by the earnings and the cash flow, so it's not as if they're not sustainable at that level. And I'll tell you, when I see a gross margin that high, I think Tollgate.
Yeah.
You know, somebody's got to pay it.
Yeah, that's an intriguing find. Only one analyst too.
One analyst, but you know, it was up a lot that year. It got to 12 times EBITDA. And clearly they had a period here where margins improved a lot. They fixed something, and the market liked that. But sales, you know, they really held up through this whole period. There's one down year, but it's down by $500,000 on a $360 million base. So I'm going to call that flat. And they kind of skated right through, instituted this dividend 5.5 times. What's the balance sheet look like? Pretty good. No debt to speak of.
Is there a place where we can see what the dividend was paid quarterly, so we know that it wasn't a big one-time payout and it's going to go back down to 30 cents?
Yeah, I just don't have that
All right, we gotta
here
look for
right
that.
now. But yeah, it could be that they just started up what's the dividend? 70 cents. So they started up a 15-cent dividend. So you got 2 quarters of it in 2010, and then.
Yeah.
4 here, but then they bumped it a dime.
Very
so
possible.
It's interesting. They're clearly sending you some kind of signal there.
Have you take a look at the bottom? This is, I don't know if we should worry about this, but look at who these guys. They're up against Equifax, Experian, Fair Isaac. We talked about these. Fair
guys.
Isaac's amazing. So these are the big boys out there. So I'd also want to know: are you guys in a niche that's safe enough, or are you really going toe to toe with Experian and Equifax?
Well, you know what? I mean, in the 10K, I think by law or whatever, they got to list their most important things first. So they provides consumer and corporate identity risk management services.
Which is not
pretty
really
niche-y.
Right, which is not really what Experian.
Yeah, I mean, these guys are more credit, evaluation guys and all that, and they mean, I'm sure they could, branch into this and harm these guys, but wouldn't they just buy them at that point?
Yeah.
If you look at these guys, they're trading at premiums. Their PEs, and there's this little comp table here, their price-earnings ratios are at a premium to intersections, which means if they bought intersections for stock, it would be accretive, and that's an easy way to tell that. If the guy you're buying is at a lower multiple than you, it's going to be accretive. And the same way, if the interest rate if the E over P is lower on your cost of capital for the acquired company, it's also accretive.
Of course, these guys know it because it's run by Michael R. Stanford, MBA.
Oh, is he MBA?
And Christopher Shennefield, MBA.
They're both MBAs. Wow.
Oh, those guys know everything.
Well, congratulations to Michael Stanfield.
Yeah.
I hope that
on that degree, that's impressive. So they would know all this.
Yeah, we're just talking to stuff they already know.
If they can sell a company, and we get to keep a 7% dividend yield for a while, and then they sell the company for, I don't know, $40 a share. Could be an interesting idea.
Yeah, I think so.
Not the best, not our best, but a good one.
All right. Okay. The show's taken a long time. All those inter segment breaks are really taking their toll here. But what do we have? We have one more name to do?
No.
Or was that it?
That was it.
Oh, great.
So we have...
so we're going to let's do a toast to the first half of the show. I thought it went pretty well with all those introductions to the segments and all. That's a new thing. I was a little nervous about it. It came out all right.
Did you take that mixer out of the refrigerator?
Yeah. Is it not supposed to be?
No, but is it yours?
No. No, it wasn't.
Did you read the sign on the refrigerator door?
What did it say?
Don't take sodas that don't belong to you.
No, but the person that wrote that...
I wrote that.
...reports to me. No, I don't know. No, I'll replace it. I'm going to... this is just from downstairs, so we can go down.
All right.
You just saved a little bit of time. Okay, so what do we got? We're going to do...
which first?
We're going to do something here that...
Sectors or...
Well, let's do this because it's ready to go, and I'm getting sleepy, frankly. How about you?
What do we...
Let me read this. Okay, here we go. You want to try it? We got to do it again now. And then what if we do this one? Or no, not that.
I know the other one.
Yeah, where'd it go?
Ding.
Okay.
You're listening to Stock Talk with the Value Guys. Next up is, we don't really have a name for this section,
do we? We don't have a name for it, no. Stuff on my screen.
Stuff on your screen.
That's what we're going to call it.
Which was a sector analysis for the last week.
Where the hell did that go?
I don't know where mine is either.
I had it here.
Wait a minute, I got mine.
Okay. I don't have mine, but maybe I can just...
You can't look at mine. No, I have secret notes on mine.
Okay, sorry. Well, what do you got? Go ahead.
All right. So here's what we did. We took the basic sectors of the economy. I don't know how many are on this page. 50.
Yeah.
Ranked them. Ranked them as what their performance was for the last week, and
yeah.
You know, I don't know that you can see much from auto parts had a huge week, up 38%. I don't know if you could say why that was the case and why, someone else was only up.
Is there a page 2?
Nope, that's it.
Huh, okay.
That's it. So the looking at the 1 week is hard to do. I don't know. Did you divine anything?
Well, all I did was I had this on my screen, and it looks like I didn't print the second page. But in any case,
half the S&P is better than none at all.
We have. So here's the thing: the Russell. We have a benchmark, the Russell 2000 value. We're a value shop, small cap value. So we had a bad week. The Russell 2000 value was down 4% this week. The S&P down 2.5%, basically. The Dow Jones down 1.4%. Well, why? I guess that nasty recession in Europe keeps coming back. It's back again now.
That pesky recession just won't go away.
It's back, and so people are a little worried about that. And then we've got we talk about this on the show, this national economic trends. If you look through it, now people are worried employment's slowing down. To me, that's old news. That was in, last week's national economic trends. But in any case, the market was down. So, Mo, all I did was I pulled this up to see what was doing well. I thought it'd be interesting. That's all. I mean, who knows?
Auto parts?
Well, the best performer in the week was auto parts, up 38%. There's probably 5 companies in there, and they did well. Who knows why? Drug manufacturers had a good week, up 25%. Healthcare up 18%. That probably suggests people are feeling a little better about, profits still available under Obamacare, or they think that the Supremes are going to, throw it out. Who knows? Restaurants had a good week. Who else? Those are the big ones. And then who had a bad week? That's what I wanted. I didn't print that part.
While you're printing that, one of the things I looked at, which I thought was interesting, was I couldn't quite put together any big picture stuff by looking at the 5-day stuff. But boy, when you look at the 3-year stuff, there are some really interesting things in here. For instance, man, this is depressing. The 3-year return for a sector, solar energy, is down 40%. Man, this has just been a disaster.
That didn't work out.
Year to date is down 16%. 1 month it was down 22%.
Yeah.
The last 3 months 30%. The last year 77%. Now for 3 years in a row, that's sort of a shame. I'm kind of green at heart. On the other hand,
how about that? If you're green, you can buy those green assets at 60 cents on the dollar now. It's a good deal. Like if you didn't go out and buy all that stuff, it's got a better price on it now.
That's true. But you would hope that, or you would think that all these ads for energy independence, that you'd see a better number for solar energy. But that's that. I guess we're getting beat up by the Chinese. On the other hand, what's also surprising is one of the best sectors has been tobacco. How does that work? Is that just
smoking? That sector's smoking.
No. There you go. I mean, that's a sector, I wouldn't have known that. That's a sector that's been up 36% over the last 3 years. I mean, it was up 32% last year.
Addictive drug.
So, who would have thought solar energy down, tobacco up? Not surprisingly, the healthcare, the medical care stocks have been the biggest ones out there. But another big sector that surprised me was, really? REITs? I guess that's just an interest rate play.
Are you looking at the right one?
That is, I think it is.
That looks like,
Oh, regional banks?
Regional banks.
That would make sense.
And
It
that's
makes
off
way
the
more
low.
sense. And then the last thing is, explain this to me.
Okay.
Casinos?
Off the low. Those things got crushed.
Up 67%?
Well, 09, remember, we're looking right at the low 3 years ago, March 09, March 2012. Anything with debt on it nearly went to zero. And so that was a sector that had a bunch of big casinos, MGM, and some others that had big debt loads, and there was fear they were going tapioca.
Well,
so,
man,
yeah.
that's big time, and they're up 31% year to date. So is there room left in
Yeah.
that story?
We have a pretty big bet in gambling around here. I mean, we own Bally's, Williams.
You own yourself too, right?
Yeah,
it's a
we do
employee-owned firm, so
ourselves,
that's the
yeah.
biggest ownership
Yeah,
in gambling
right.
that you could make.
Yeah, but no, we have a smattering of gaming-related stocks, as we like to say. Well,
Is a smattering more or less than a handful?
it's less. We have about a 3% weight in gambling. I'm giving away a lot of secrets here on the show.
Anyway.
So anyway, that's interesting. I can't get the bottom half to print, but I'll just throw out the couple of bad areas were aluminum, utilities, insurance. I don't know, medical distribution. Who knows? I just had that up on my screen. So, well, do you want to do this other segment, or just maybe save it for next week? We're at 45 minutes. People need to get going home, don't you?
Save it for next week?
Yeah.
And we are the Value Guys, now also on the Financial Survival Network.
That's right.
And
also,
we are on YouTube.
We're on YouTube now. And we're on 1490 WGCH. And that's on Tuesdays on the Financial Survival Network. So thanks, everyone, for listening to the Value Guys Stock Talk Show. See all our caveats at www.thevalueguys.com, and look forward to catching you again next week. Thanks, everybody.
Have a good weekend.